Good afternoon. This is Sean Golding with Golding and Golding here to do a little cursory overview of what tax implications, rules, and requirements foreigners have when they come to the United States. It's overwhelming, right? You come to the US, you have a million things to worry about. The last thing you're worried about is how to file your taxes, usually, right? And in many foreign countries, it's much easier. In some countries, for example, you work or you have investments and all of that income is withheld. And then you just get a document basically showing what was withheld and you sign it and send it back unless there's any changes. And it's very straightforward. The US doesn't work that way. The tax code is ginormous, it's always changing. The rules are in flux half the time. There's regulations, there's proposed regulations, there's notices, there's announcements. The IRS changes things, they don't tell you, etc., etc. So let's just kind of walk through the basics of you come to the US or you otherwise obtain US person status and you're subject to taxes and what happens next, right? So, first things first. Are you a US person for tax purposes? If you read some of the information out there, it makes it sound like it's just US citizens, but that's not accurate. Three main categories of individuals. And we're just talking about individuals, businesses, territorial rules, way different. We're just talking about individuals coming to the US and gaining US status and looking at that tax return for the first time and thinking, what happens next? US citizens, born or naturalized, lawful permanent residents, and visa holders that meet the substantial presence test. So just having an L1 work transfer, H1B, B1, B2, you don't get taxed on your worldwide income, but if you meet the substantial presence test, which is a whole nother presentation, it's basically a counting days test. And if you meet that, well, then you're subject to tax just like citizens and permanent residents. It's a catch-all, and it's really not fair. If you fall into any one of these three categories, the default rule is that you're taxed on your worldwide income and you have to report your foreign accounts, assets, investments, entities, etc., on various different international information reporting forms, FBAR, FATCA, Form 3520, etc. Now, if you're not a citizen, typically if you're a permanent resident then and you don't live in the US, then you may qualify for a treaty election if you meet the substantial presence test because you're a visa holder and you've been here for a long time, but you qualify under other exceptions. Maybe you're a student, maybe you're here for certain kind of research activities, or you have a closer connection to a foreign country or countries, then you may qualify to not have to pay tax on your worldwide income, but those are exceptions, right? The main rule is that you're taxed. Worldwide income, right? It includes all types of income. So, if you have foreign employment income, 1099 for example, or maybe you're living in the US and you're earning some side hustle overseas, that income is still taxable on your US tax return because the US taxes you on your worldwide income based on your US person status, not the source of the income from a baseline perspective. Like I said, there's always exceptions, exclusions, and limitations. But if you're a US person and you're earning money overseas, then you have to include that on your US return. Now, maybe if you're overseas, you qualify for the foreign earned income exclusion. Maybe you paid from foreign taxes and you have some credits, but you still have to include the income. The same thing goes for passive income. In some countries, passive income for the most part is exempt. Interest, dividends, capital gains, royalties. Even if it's exempt overseas, it's still included on your U.S. tax return. And even if you paid foreign taxes, you include it on your U.S. return. Which brings me to a quick thing. Let's use numbers as an example because it makes life easier. You earned $1,000 of foreign interest income and you paid $200 of tax overseas. That doesn't mean you report $800 of income on your U.S. return. Some people think, oh, I'm going to do that. It's going to reduce my tax. In fact, it'll increase it. What you do is you report your foreign income in total, 1,000, and then you report the taxes paid separately as a credit. Then you get a credit against U.S. taxes. There's a whole equation. It doesn't always match a one-to-one, but you get credit. So you report the gross, and then you report the foreign tax credits. In addition to having to report your worldwide income, you also have to report your global assets, foreign accounts, investments, pension plans, life insurance policies with a surrender value, mutual funds, securities, equities, etc., etc. You have to report the foreign accounts whether you open them in the U.S. or it predates. So just because you had the accounts open before you came, even if they don't generate any income, they're still reported on on your U.S. tax return and FBAR, excuse me. So you have to see each year that you're doing the reporting, it's like a snapshot of what you have at that time. So you don't get to exclude what you had before you came to the U.S. It's just a snapshot of what you had when you file. Like I said, even if there's no income, even if it's a dormant account, even if it's very low balance, you haven't used it in 30 years, if it's open and you otherwise meet the threshold requirements, you include all the accounts. Same concept, you have to include foreign pension plans. Just because the pension plan was open before you came here doesn't mean that you can exclude it. Whether it's employer or personal may impact taxes. You know, if there's a treaty, if it's employment born, if it's just a personal pension, which is just like it's just a wrapped investment. But you still have to report it, and there's various different forms: foreign mutual funds, foreign securities. In addition, gifts. And gifts really throws people off. And at the time of this presentation, let me take a step back. When you have to do foreign gift reporting, it's a Form 3520. The IRS loves automatically assessing penalties, 25% penalty. So you got a gift for $400,000 from your sweet grandma because she loves you very much. And you're like, why do I have to report that? There's no income implication. Well, you have to report a gift if it's more than $100,000 and it could be from one person or related parties, but you have to report it. If you file it late, the IRS loves issuing automatic assessable penalties, and typically it's going to be a year or two till you figure it out. So that's a 25% penalty. That's a $100,000 penalty up front. And practitioners and taxpayers have been complaining to the IRS forever. And recently, at the end of October, at a conference at UCLA, I was not there, but on the National Tax Advocate website, they stated that the commissioner indicated that they have every intent of changing that rule so that taxpayers have a chance to avoid the penalty instead of getting automatically assessed. But you could see how important reporting is. You know, the IRS really likes to ding you even if you don't have unreported income. So, if you're hearing this presentation and you've been in the U.S. for a bit and you haven't filed or reported, take a step back. You'll be fine. There's various offshore tax and amnesty programs you can submit to get into compliance. Don't let anyone fear-monger you that you're going to prison or that the feds are going to bang down your door. It doesn't really happen that way, okay? If you're willful, you do the voluntary disclosure program. If you're non-willful, there's lots of different programs available. There's the streamlined procedures, delinquency procedures, and reasonable cause. We got a ton of free information available on our main website and our sub-websites. You can always reach out and schedule a reduced fee initial consultation if it's appropriate to your matter and it's something that we handle here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.